and welcome to the Layer 1 podcast. My name is Kelvin Sparks, and I'm joined by my co-host, Stephen Gates, the co-founder of Hypha. I'm excited to introduce our guests today, Haseeb, an investor at Dragonfly, and Sean, an investor at Fintech Collective. Welcome to the show, guys. How are we all doing?
Doing good. Thanks for having me.
Yeah, doing well, Kelvin, Steven. Thanks for having me as well.
Doing great as well. Excited for the very first podcast of the Layer 1 pod.
Yep. Let's make it a fun one. And before we begin, Layer 1 is a podcast focused on the intersection of crypto and the real world. It's brought to you in collaboration with Avalanche. Nothing we say in this podcast is investment advice or financial advice. Make sure to always do your own research. And in today's episode, we'll be talking about the Avalanche story. So, guys, before we dive in, it's rare to have two professional or former professional poker players. So how does poker and game theory play into how you think about investing in crypto markets?
Sean, you want to take that?
Yeah, the poker to crypto pipeline is a robust one. I always like to say crypto and just investing in general is making decisions with extremely limited information available to you. You don't really have the full picture. And poker, very similar, right? You know your holdings. You clearly don't know the hands of all your opponents, and you're trying to use the data around you to surmise what the best the best outlet for your play would be based on your probabilities, right? And when we think about investing and just investing in general, right, not just crypto investing, I think about the world pretty probabilistically. The best you can do is describe probabilities to the hands of your players, and it's kind of the same thing in crypto investing. So I think there's that uniting thread, and why the pipeline is pretty robust. Poker also is a risk-taking game. So if you've got an aversion for risk, you probably don't have a place within the crypto world. This is really early stage startups. Even the things that are scaling at this point, I would still say are kind of early in their life cycle. So for all those reasons, between like the ability to take risk, understand risk, and think about the world probabilistically, I think it's a pretty good lens in which to view the crypto investing world. So yeah, those are kind of the main highlights, I would say.
One of the things that I think a lot of people fail to understand, especially when they first get into investing, is something that you learn very deeply as a poker player, which is that as a poker player, you learn you cannot win every hand. It's literally impossible, right? Poker is too stochastic. And so the poker players always ask themselves, what's the best line in this hand? Meaning, what is the best overall strategy when I'm presented with this hand to make my way through all the decisions, right? Okay, what do I do on the flop? What do I do on the turn? And as a poker player, sometimes they're going to have it. Even if I should be playing as though they don't have it in this spot, sometimes they're going to have it. Just, they're going to have the nuts. They're going to have this, a straight or a flush or whatever. But I should still play as though they don't, even though sometimes I'm going to lose. But in investing, people really struggle. I find a lot of traditional VCs, they really struggle to understand and internalize this concept. Like for example, I think there is no way, it's like actually impossible to invest into Plasma and BitTensor and Ondo. Now, all three of those are great investments. But the kind of investor you have to be to invest into all three of these is just so different from each other that there is no investing strategy that could somehow encompass all three of those investments, right? There's something like this you can imagine. Like the optimal investing strategy does not involve you hitting every single big winner. You will always miss some because there's only certain real strategies that you can actually have that are coherent and that you could realistically follow. The same thing's true in poker. The best poker player in the world against the worst player in the world is going to win 70% of hands. They're not winning 90% of hands. They're definitely not winning 100% of hands. And the same thing is true in investing. You're always going to miss some stuff. The question is not, why did I not get every single winner? The question is, what could I do at the margin to get a little bit more of the winners or to be a little bit better as an investor? But you can't look back at the year and say, okay, why didn't I hit every single one of the winners that ended up popping off? Because sometimes it actually is just random. Sometimes it is difficult to predict. Sometimes the better startup at seed stage isn't the startup that wins at Series A or Series B. But if you make your decision early on, you end up picking the horse that you pick, and you kind of have to just believe with that and go with it.
Yeah, just to layer on to what Haseeb said, we talk a lot about just like being process and not result oriented. You've probably heard that echoed by poker players ad nauseum. So to Steve's point, like the results, like you might play the hand absolutely perfectly in a high equity spot and still lose. And for most people, that could be like highly demoralizing. I think in the world of crypto investing, you have to take that same line, no matter, even if you knew the results, right? Like you focus on the process, your decision making, right? And it's the same way in which you approach investing.
So, what was the biggest risk, whether it's at the poker table, in the crypto markets, or life in general, you've ever taken? And what was the potential payout?
And you have to be honest.
I have to be honest. So in terms of poker hands, honestly, I mean, this is a question that people will sometimes ask me, and I honestly don't remember. At the time that I was a poker player, I did remember. I'm sure it must have been at least like 300 grand. I think that was on the line in some particular. I played some very, very high stakes poker games at some points, but they're honestly not that memorable. It's kind of like I don't know. It's like if you play professional sports, like it all just kind of runs together. Like the things that are most memorable for me are actually not the biggest hands. The things that are most memorable for me are the hands that I felt the proudest of, or that I made the toughest decisions. Oftentimes, actually, big pots are not tough decisions. They're often very easy decisions. That's why both people are getting their money in, is because they're both very confident in what they're doing. So I remember I played some gigantic game against Gus Hansen, and there were some huge pot limit Omaha pots that I played against him. I'm sure our equity was like 45, 55 or something. It was basically a coin flip, but we both kind of had to put our money in. I'm pretty sure that was the largest hand I ever played. But I don't remember if I won or lost, to be honest. In a way, it's just not how poker players think, right? They think more about the strategy. It's kind of like, the best chess game you ever played in your life might be like in a park with some old man rather than, playing at the highest stakes. I don't know if that's true for for chess players, but at least for me as a poker player, the proudest moments that I had as a poker player was when I completely outmaneuvered somebody, or I made some amazing read that nobody else could have possibly made but me because of what I knew about that player. But those were not, massive, enormous pots. They were just great moments where I did something that really felt like true mastery.
Well, I think that sounds like that's what makes you a true competitor. Sean, what do you think? Or do you broadly echo Haseeb's points here?
Unfortunately, I do remember some like the more some horrible big hands, and like I'd love to like I made the right call. Like I remember I was at the final table of the World Series, and I had a kid to my right. I think I was young at the time too. This was 10 years ago, so I was maybe 26, 27, and the kid to my right, well, he must have just turned 21 years old. And my read on him is like he was, and the way the payouts work in poker, especially tournament poker, they're highly exponential. So the game theory optimization is to play for first. Like it's not necessarily wrong. So it's like kind of this convergence between your ability to take risk and understand payout structure. And on like the first hand, we just got moved to the final table. There's like these moments that I see probably could also echo, like coming back for dinner after in a big tournament. Like it tends to be more lax, and it's like a moment in time where like you could probably take more risks. And it's the same thing like getting moved to the final table. It's like you've made the final table, you don't want to be the first out. And on the hand, it folded around to him, and he probably had like 28 big blinds, and I maybe had like 25. And poker, you very similar to crypto. Like there's nomenclature; it's very specific to crypto. It has its own vernacular. So big blind is like the multiple of like the ante that's in. And a lot of the game revolves around like what multiple you have of that ante. And the very first hand at the final table, he went all in. And it's funny. I looked down and I like king, queen suited. And I was like, I know like his range here is like shoving everything, like literally everything. Because a lot of dynamics I referred to, like it's the first hand at a new table, it's the final table, the payouts are exponential. Like you begin to have like what's called like ICM. And it was a really tough call. It was the right call. Like you run it through these simulators, right? Of like what you do and all these different hands based on the range that you have and the range your opponent has. And I called, and turned over 10-2, not even suited, Haseeb. It was 10-2 offsuit. and I wouldn't be telling this story if I won the hand. Flop was like trip twos. It was like dead right after the flop. So it was quite a devastating moment. But yeah, I mean, like the process was correct. And you gotta understand your opponent really well and yourself. So yeah, interesting hand. But yeah, I would love to say you always focus on just the process and that's what you take with you into the next game. But yeah, it's kind of those moments you remember these really big equity pots you lose.
I feel like tournaments are more momenty, whereas I was always a cash game player, and cash games, it's very different because it's just like it's the same shit every day. You know, there's not like the big moment for a cash game player, except maybe the pots get particularly big, but it's a lot more normally distributed for cash game players compared to tournament players. Tournament players, like, you're only going to final table a few times a year. And when you do, it really, really matters how it ends up going. So it's very lopsided, I think, in terms of the importance of particular games when you're a tournament player.
But I guess you would say that's more similar to venture, though, right? Because like it's a hit-driven business, right? Like in any given fund, it's like you've got to have 1 to 3 investments that return the fund. So it's from that perspective, it is a similar construct. But yeah, you had the more even distribution of cash.
That's right.
I was just going to ask about that as well. So tying in the poker process, the poker mentality over it to translating into your day-to-day jobs here in crypto, especially this very specific moment in time that we're at in the industry. Like 1010 just happened. DATs are now live. Seems like institutional bids are going to be happening through DAT vehicles, at least for the majors. Liquid funds, a lot of leverage traders got put maybe over the skis a little bit, now on the back heels a little bit. Seems like retail traders, okay. So one, like, I guess overall, always the question is health of token launches. We saw today, as of recording, Coinbase just announced that they're having a token sale platform. Previously, maybe a week or two ago, they acquired Echo and Kobe and his brand. So Coinbase obviously leaning in, putting the gas on the pedal for token launches. At the same time, we're seeing liquidity get constricted. So now you guys are standing right in the intersection of figuring out, you're not constrained to only token launches, right? Or, like there are also equity vehicles that might go the more traditional Web2 kind of IPO track or path. So how are you guys thinking, kind of applying your poker process, the competitor mindset, this mentality that you have over into figuring out, okay, for this very specific, crypto's in the middle of puberty right now. I'd say crypto is like a 14-year-old boy at the moment, right? Like first couple pimples have showed up. Do you think it's a little...
Oh, geez. All right. So I'm going to abandon this 14-year-old boy analogy because I don't know where that's going.
I was hoping you'd lean in. No, I'm just kidding.
No, I'm leaning out. I'm leaning out. Sorry to say. Okay, a few thoughts here. Kind of zooming out a little bit from the market. This is one of these places that I actually don't think poker is very useful of a skill set for VC. I think it's actually very useful for trading. Very, very, very analogous actually between poker and trading. And most of the poker players I know have gone into crypto on the trading side, not on the VC side. Poker players tend to make terrible VCs. I know a lot of poker players who have done a lot of things. Very few of them have become successful VCs. I think, Sean and I are maybe the exception among even our peers. The reason why is that VC, unlike poker, is a very, very, very long-term feedback loop type industry. It's also an extremely social industry. Poker is famously antisocial, right? Poker, you go sit down at a poker table, you put the hoodie over, put the sunglasses on, you sit there kind of ruffling your chips, not talking to anybody. And it's kind of a PvE game, right? Like it's you against the world. Everybody at the poker table wants you to lose. Nobody cares if you win. And it's strictly zero sum, right? Or even negative sum because the house takes a rake. Venture is the opposite. Venture is very, very slow feedback loops. You don't know if you made the right decision for a long time. It's also very social, right? So there's no kind of, sitting in your room with your cap on, with your sunglasses, cutting yourself off from the world. It's also extremely positive sum, right? So as a VC, you win when other people win. You cannot win by yourself. You win when founders win. You win when your team wins. So it's a team sport in the truest sense of the word. And most of your time is really spent with people, not, alone in your head. So in all those ways, it's very unlike trading. Trading has a lot more in common with poker in all those dimensions. than venture does. That being said, I do think there's ways of thinking and approaches to risk and self-mastery that poker teaches you. But for the most part, the core skills of venture are really pretty unique. So the number one thing I think that as a poker player, you never had to really deal with, that in crypto you do, is this kind of dark night of the soul about the industry or about these sectors that, I never saw anybody in poker be like, oh man, poker's cooked. Poker's not going to make it. Poker was all a scam. Poker's never gonna... Like nobody in the gambling world thinks that way or even has that conversation. They might think that about themselves or their own lives or their lifestyles, but they're not thinking of that about the sector. Crypto, you get that like every 3 months. People are, having these existential crises about whether crypto is going to survive or whether tokens are meaningless or whether financial nihilism or all this stuff. And, I've been in the space long enough that I've seen so many ups and downs of it. And so a lot of what I think the present moment demands is just calm the hell down, to zoom out a little bit, take the big view of all of the things in crypto that have been working, whether it's stablecoins, whether it's tokenization, whether it's RWAs coming on chain, whether it's institutions adopting crypto. Like, yeah, okay, leverage blew out on 1010, and yeah, okay, token prices are up and down. Yeah, okay, debt premium have come down. But like, again, zoom out, look at the big picture. Everything is fine. Everything's going great. Crypto is as good as I could have possibly imagined it to be a year ago when I was looking at this industry, much less 3 years ago after the collapse of BlockFi and FTX and Celsius and Luna and all XT Infinity and all of this stuff. Like, we are in an amazing place as an industry. And it's important to internalize that. Bitcoin's over 100K. Ether is more than doubled since the beginning of the year. Like, we're fine. Yeah, things could be better. They could always be better. Things are fine. That's like the first and most important thing that I want to communicate to people.
I love that. I feel like that's the venture side of your brain talking to the poker side, right? Or having but seriously, like having a more longer term view, because I think each individual thing that you said is completely correct. I mean, Sean, what do you think?
Yeah, I would echo a lot of Haseeb's points. I think where, I've been on both sides, right? I was a fintech VC for 6 years. I've been a crypto VC for 4. Our book is, and Haseeb's book as well, like even if he's early stage investing, the IPO, if you will, or when a token goes public and the life cycle of a company is that much earlier in crypto, and the skill set in managing risk after a token goes live is demonstrably different. Our book is quite liquid. Like I'd say of the 2 digital asset funds that I run, about 85% of it is liquid today. And where I'd say so I agree with Haseeb, and a lot of poker players probably would not make really great venture investors because the feedback loop is so long and it's very tough to like make incremental changes as you go, because you really don't know if your strategy works or not. And it takes a long time. But I will say, and I alluded to with the comment I made about like the final table that I was at in the World Series of Poker, you really have to deeply internalize like what regime the market is in, especially in crypto. And the pendulum for what type of regime the market is in crypto changes quite often. So if we were having this conversation a year ago, on-chain was explosive, right? We were talking about the AI meta. GOAT had launched and it went to $1 billion plus on-chain. You had AI 16Z, Solana meme coins. Murad had just put out his list, and it was like inevitable that 10 coins were going to be worth 20 billion plus. I don't think Haseeb or anyone here believed that completely. I'm not sure if Murad, who I know personally, really fully internalized and believed that, but I think there was enough belief in the market on that. It was a retail-driven cycle, right? Fast forward to January and Trump coin launches, and we had this amazing onboarding event, and everyone's so excited. People are onboarding through Phantom and Moonshot. And there's an opportunity for PVE, right? Everyone's going to make a lot of money. And, the Trump meme coin, of course, it's going to be worth $50 billion. Like, can't be worth less than Doge. Like, it's the president of the free world. And he's now in like the highest position of power supporting crypto. And then boom, Melania comes. And that completely takes the air out of the wings. And that's followed by Malay. And then the meme coin bubble completely pops. And on-chain for the last 3 to 6 months has been dire, right? Like you can't get a runner like on-chain to go past really like $50 million. But what's happened? Like crypto is not dead. It's far from dead, as Haseeb just mentioned. Like we are in an institutional cycle around stablecoins and tokenization and borrow and lend. And every single enterprise and institution now has to have a digital asset strategy. Now the market's also bifurcated between whether or not an asset has a DAT or not. Does it cross the threshold of like being a large enough asset? Does it have value accrual? And it's kind of put us in this, what people are now calling the revenue meta, but like it's the way the lens in which crypto should always have been viewed is like, does this thing have product market fit? And does any sort of cash flow accrue to the token? Or is there any reason to hold the token? And as you think about more sophisticated investors coming into the space, which is now happening, maybe not as quickly as people are hoping, that's the lens that they're looking to evaluate the universe of digital assets. So we've flipped from a retail-driven cycle into an institutional cycle. The dynamic has changed really quickly. It's like we just went from the two tables where you're playing really aggressively into this final table where now the game theory is to play super tight. So, like you just have to understand where the marginal bid is coming from, and how aggressive you could be in your allocations, and where you should be looking changes based on this market regime. So, and if we were having this conversation a year from now, I'm sure, that conversation may be inverted. But that's kind of how I think about it. It's like, that's the overlay in which you view the market, right? It depends on like how high the blinds are, like how aggressive everyone's playing, like what's the price structure. So from that respect, I think you can look at it from a more risk management mindset.
Well, so let me also qualify what Sean just said there. So any investment that you're making today, right? Let's say you invest at a seed round, or you're leading a Series A. If they're doing a token, let's say they're doing a token. Even if they're doing a token, which supposedly is like fast liquidity, right? Okay, it takes like a year or two to like build the product, and then you launch it, and then you're not going to, you're going to do points, and then eventually you're going to do your TGE. You do your TGE as an investor. You have 1 year lockup, and then you're going to be vesting over the next 3 years, call it. So maybe by the time if you invest today into a company, you're getting your first liquidity, call it in like 3.5 to 4 years. Okay. That means 3.5 to 4 years mean it's going to be 2028, 2029 by the time that you actually get liquidity, which means 2029, there's going to be a different Fed chair. There's going to be a different president. It's going to be different interest rates. It's going to be a different market cycle. It's going to be different fucking everything, right? Nothing is going to be the same by 2029. Like 2029, we might have a quantum computer by 2029, right? Like it's an entirely different world. And so what that tells you is that you also can't index too much on the current market regime, because if you assume that crypto has 4-year cycles, which, TBD, whether or not we're actually in 4-year cycle land, or if the institutional bid has changed the way that crypto functions, like one thing that's very clear is that in 4 years, anything that you're describing about what crypto is like today is probably going to look different, right? And on that level, you have to be drawing the line forward, which is to say, okay, institutions right now are the only bid for crypto. Will the on-chain economy, will the retail bid, will the, changes interest rates, will all those things change the prospects for this company by the time it actually sees the light of day and I potentially have a path to liquidity? Now, if you're talking about an IPO, that's even farther out. You're talking about an IPO, that's like 6-7 years out. If you're investing in something that's a seed round or maybe Series A, maybe 5 years at best that you have to IPO. What all of that implies is that you cannot hew too narrowly to what the market is telling you today, right? Just to give an example, we invested into Athena. Athena is a delta neutral synthetic dollar, and it's like the third biggest US dollar backed coin in existence today. And we led the seed round of Athena it must have been like 6 to 8 months after Luna collapsed. Okay, after Luna collapsed, nobody wanted to touch stablecoins. Nobody wanted to touch DeFi. Everybody thought this whole space was cooked. Valuations were in the toilet. And everybody was like, "What? Why on earth would you raise money for something so obviously untouchable, like a non-US dollar or like non-fiat backed stablecoin?" And the answer, of course, was like, "Yeah, people feel that way today, but they're not going to feel that way in 3 years when this product fucking launches." And this product actually launches a token, which it took about 2 years from the time when we got the seed round pitch to when they actually launched the product. And of course, the market, the environment, everything was totally different 2 years later after the collapse of Luna. So you have to, as an investor, you have to understand, and you only really get this intuitively once you've invested enough times, is that the market is just totally different by the time a product launches. in crypto, assuming that there's a long product development cycle and assuming that you're investing early stage from when you're actually originally looking at the deal.
Well said. I guess since we're kind of talking about DeFi adjacent topics, we saw a lot of issues recently with stream finance, obviously funding rates, debates on Twitter, the balancer hack. And I'm kind of curious, like, do you think DeFi is actually ready to scale in order of magnitude? If not, what's preventing it?
Well, it's already scaled a bunch of orders of magnitude. So, I remember DeFi when it was like 50 million TVL across all of DeFi. Now we've scaled many orders of magnitude. So we're now in the 50 billion range rather than the 50 million range. Can we add another zero to that? Probably. I mean, it's harder to add each subsequent zero, obviously, because, there's just not as much money in the world. You really have to start going institutional to start getting more and more capital. But the answer is like, look, I mean, what happened with Balancer is really unfortunate. It's a very well-respected OG protocol. But the reality was that, $70 million hack for an old version of the second or third largest AMM. I think third largest AMM because it's like, Uniswap, then PancakeSwap, then Balancer. It's their old version and only the pool that had ETH in it. If you had 3 ERC20s, then that kind of pool was not vulnerable to this attack. Look, these kinds of attacks are terrible, but this is not like the crown jewel of crypto. This is not like, oh my God, the beating heart of crypto was just, torn open and extracted. These kinds of things shake people. They're a wake-up call for everybody to go look at these old contracts and to try to repair them. But remember, all of technology has always had software bugs, right? So if you remember Spectre and Meltdown, you remember Heartbleed, like all these kinds of bugs, they happen. All software is going to be vulnerable to bugs. The important thing is that you have, one, very robust processes around remediating and solving these. Another thing that does strike me is we kind of need something like a Project Zero in crypto. If you guys know Project Zero is this thing created by Google where they basically hire the best researchers in the security industry to just go through open source projects, basically as a public service, and find bugs and responsibly disclose them. And actually some of the most cracked white hat hackers in the world work for Google under Project Zero. It's basically like a public service that Google just does to make the internet more robust. It feels to me like crypto, it's probably time for us to have something like this in crypto. Instead of just having the teams themselves and having, bug bounty teams going out there, so individual auditors who just go out and try to make some money finding bugs, having a professional organization that's basically a public service that's maybe subsidized by some of the big organizations in crypto. I think something like that would go a long way toward balancing out the risks and reward for attackers who are going after these protocols versus white hats who are trying to protect them. So I think for the most part, DeFi is fine. These things are setbacks. Stream finance, different story. Sean, I don't know if you want to go at stream finance if you spent much time on it.
I've not spent as much time as you probably have, so I'll let you hit that one, and then I'll circle back to some of the points.
Sure, yeah. Okay, so stream finance. Stream finance is one of these like delta neutral, it's sort of Athena style coins, except unlike Athena, it was totally non-transparent. It was tiny. I literally never even heard of it until I heard that they had lost a bunch of money. So basically the way the stream finance works is you put money into stream finance and then they take the money off chain and they do something with it. And they don't tell you what they do. We still have no idea how they lost the money. They do. Apparently people are saying that they did some kind of like vol strategy where they were like super short vol. And of course that blew up on 1010 and they ended up exploding and losing a ton of money. They didn't have daily, so apparently they have like daily redemptions and deposits. So it's like a hedge fund basically. And it's not like real time, right? So you look at something like Athena, you know exactly what they're doing. They have daily, not daily, instantaneously real time visibility into the reserves, into the P&L. All this stuff is getting reported. Like it's crypto. The whole idea is that it's crypto, it's permissionless, you can see all of it in real time, it's all held with custodians, there's no counterparty risk, you know exactly what they're doing at all times, right? Whereas this thing, completely opaque. Literally, they were slinking back into the market weeks after 1010 to say, hey guys, sorry, we don't have the money anymore. Probably they lost it in 1010, we don't know. A law firm has been appointed to go figure out what the fuck these guys did and why the money isn't there. But they are literally not even telling us. So the stream finance and some of this other stuff that's blowing up alongside it, these were basically levered looping strategies, almost certainly. They were very, very leveraged. And all these levered looping strategies, like they're leveraged, right? Okay, you take on leverage. when there's a leverage blow up, like you see in 1010, all these leverage strategies are gonna get knocked out. So anybody who's taking really high risk and getting super high yield, right? People complain these days. They're like, oh man, the Athena yield, it's come down a lot. It's like 5-6%, whatever. That's not so interesting compared to treasury yields. That's because what they're doing is safe. If you're getting 25% yield, you're taking a bunch of risk. So what does taking a bunch of risk mean? It means that in a 5 sigma event like 1010, probably somebody who's taking a bunch of risk is going to lose a lot of money because their levered looping strategy or whatever it is they're doing is going to get blown out. So that's what ended up happening. Probably there's more things like it that were taking 25% yield. You cannot get 25% yield without taking a lot of risk. And where does that risk manifest? It manifests in stuff like this. Now, thankfully, these things are pretty small. So again, $90 million was lost at a stream finance. That sounds like a big number. Relative to all of the TVL in these strategies, they're a very small player. And so these kinds of things happen, right? You look at the private credit market, enormous market. We've been recently having all these news reports of big write-downs in the private credit market. But this is normal. This is what happens when you have a very, very large market, is that there's going to be some bad loans. There's going to be some bad stuff that happens in the portfolio. The important thing is the overall market is not exposed, right? So if you see this random strategy blew up and then something bad happens to Tether or to Athena or to something else big, but none of those things happened. In reality, these were all pretty isolated events, and this is absolutely normal in any kind of junk bond, private credit type market. You're going to see some portion of these high yield strategies blow up.
Yeah, I think you take that and you add in, sorry, Sean, and you add in the fact that everything, as Sean mentioned, is an early stage startup in crypto. It's like, it is absolutely inevitable that stuff like this is happening, will keep happening. I don't know if calling
it startup is doing it justice. I think this is more just like I think this is just private credit.
Yeah,
that's what this is. Or it's a hedge fund.
Yeah. Some dudes figuring out what to do with money. What's up, Sean?
Yeah, Balancer, I will not lie, like for me was quite scary in terms of like Balancer is like one of the first protocols that got me super interested in DeFi. The idea you could like passively put money into an index and like I don't have to pay the person who rebalances it. I get paid as the liquidity provider. But to see his point, like it was a very old contract. I think it reminds people like you want to have immutable code to extent you can, but like there's a reason why a lot of DeFi protocols have proxy contracts and these get updated over time as new fixes come out, and like why a lot of these protocols have really big bug bounties, right? Because at the end of the day, like I still think for most of these hacks, unless it's North Korea, like there is some repercussion. You do usually, since it's on a transparent open blockchain, you can locate the individual or figure out, triangulate to who it may be. But I don't think that's the reason why we haven't scaled in DeFi. I think there's a couple other reasons why we haven't been able to get past this like $150 billion number. A lot of it is tethered to like just the size of these large layer one assets, like obviously Bitcoin, Ethereum, Sol, that get used as majority of collateral within these systems. But I just think from an institutional perspective, I think a lot of crypto projects services that like prosumers use to be like gold standard for institutions, or like the way in which institutions will use these services. And I just think that's a fallacy. Like the idea that you could have like a large, like multi-billion-dollar utilization-based lending market and like large institutions are going to come in without like certitude of what the rate is going to be over time. Like the way Aave works in its current format, like that is not a institutional architecture. I kind of similarly feel the way about Hyperliquid. It's like no insurance, no first loss. Like HPL didn't take any hit. I really would struggle to see large institutions allocating to DeFi platforms under the current construct. So like there's something to be said for like not getting liquidated overnight, and like these more white glove services that utilize smart contracts under the hood, but it's not like black and white, right? They use smart contracts as part of it to help manage the collateral, but they also call you up and tell you like, Haseeb, you're about to get liquidated. You might want to top up and like give you the opportunity. There's risk with that, right? Like someone has to take on the risk if the price is lower. That's why there are insurance funds or like tiers of like preferred capital within capital structures for many exchanges in the real world. That's why there are clearinghouses. I'm not saying like, let's take the existing format of TradFi and like insert again all the intermediaries and costs. But I think we just have to recognize a lot of these systems were constructed this way for a reason, and they've went through a lot of calamities and thinking through like what can we take from the old world of finance into this new world of DeFi if it's going to be institutionally ready. And then I will just say like just like the appeal of like just only crypto native assets. I mean, I really only think there's a few assets that have traversed over into the mind share of large institutions, whether that's the Bitcoin store of value, ETH as like the smart contracting platform, and Solana as the faster version. I think when we get more real world assets, whether it's private credit, tokenized equities, I think these different protocols become more interesting to institutions again. And once again, I don't think it's going to be like all on public permissionless blockchains. Is it going to be on a Canton? Is it going to be on a semi-permission version? I've seen Haseeb talk about this on podcasts, and I kind of second it. It's like, I'm a crypto native person. I still don't love having like, I'm not sure if Coinbase offered tokenized equities. I would put all my brokerage activity onto Coinbase. There's something to be said about opening up my E-Trade Fidelity, knowing that like if I got zeroed out, there's some remuneration. And like you could say like, of course the asset issuer can move the asset, can reassign it, but like what happens on these hacks is someone moves very quickly to a permissionless asset like, Lido staked ETH or ETH. So I think there's going to be some middle ground that might break composability a little bit, or like it might not be as fluid moving between like the institutional chain and the fully permissionless chain. But I just think the vast majority of institutions and retail are just not ready for a world in which like they could open up their account and get zeroed out. And so we need more interesting assets. We need better risk parameters, controls, and kind of like a hybrid approach. Like, DeFi in many ways is a continuum. And I think as institutions enter, I think we're going to see more of that approach than we will see like, winner takes all. This is all going to be permissionless and sit on Ethereum or Solana.
So I'm hearing a few things there, Sean. The first is in terms of a maturation point, that the infrastructure around DeFi and kind of the extra services that are required for institutions to onboard right now, that's definitely a gap in the market. And that's something that definitely to compete against Wall Street, compete against TradFi offerings, like a market needs to be created around that, right? To keep chipping away and keep onboarding liquidity. At the same time, I can't help but think to myself, there's so much liquidity in the world that probably both models can win. But which one is the most interesting opportunity kind of moving forward into the next 3 years under a new Fed regime, right? As he was talking about, next 3, 4, 6 years moving forward, is it stablecoin DeFi or is it altcoin DeFi? How do you guys think about that?
Stablecoin DeFi or altcoin? How do you define stablecoin DeFi versus altcoin DeFi?
Using stablecoin, so DeFi net. Move money on chain, create capital efficiencies, charge a spread on that, right? Like that's what we know and love. And then from what I see is like what Athena is charging forward on, that's like stablecoin DeFi. Like you onboard your USDC liquidity or onboard USD, and then now USD is the base monetary asset that you're constructing DeFi mechanisms around that cash flow. Or is it altcoin? For example, like ETH DeFi, Solana DeFi, AVAX DeFi, right? Like $1 coming into crypto now is a choice. Do I stay as $1 and plug into kind of the on-chain Wall Street, or do I convert myself through some vehicle? Probably more likely is probably through a vehicle, and then I purchase AVAX and I stake AVAX and then play and do AVAX DeFi.
Yeah, okay, it's an interesting way to frame it. I don't think about it in quite those terms, but I think you are right that there will be a bifurcation. I don't think it's so much between stablecoins and altcoins, because whether you're doing stablecoins or whether you're doing altcoins or not, like stables are the de facto pair against which almost everything trades. So whatever you're doing in DeFi probably attaches to stablecoin somewhere. I think the real question is more on the RWA side, right? So like on the RWAs, it may just be that basically you have stablecoins and RWAs and you don't touch alts at all. And then there's the world where you're lending USDC, or you're providing USDC to a market, and people are borrowing it against their collateral, which is crypto, and some people are borrowing it against ETH, and some people are borrowing it against wrap Bitcoin, and blah 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 blah. So I think it's more likely you see that kind of bifurcation where, and I think a lot of this comes down to who are the set of borrowers and what are their real preferences? Like, why are they coming on chain? Historically, the people who've been on chain are all basically on chain to speculate, right? They're the people who are here to YOLO, and this is the YOLO part of their portfolio. So, like to Sean's point, part of the reason why a lot of these tokenized stocks and stuff are not really taking off yet is because the people who are here are not here to buy stocks. They own stocks. It's not like people who are on chain don't own any stocks. They do. They just own them in their Robinhood account, or they own them in their Schwab account. They open in their Fidelity account. And so the savings behavior is happening off chain, and the investing/speculating behavior is happening on chain, right? What a lot of the stablecoin finance and fintech and all the distribution that we're seeing now over the last 12, 18 months, what that's doing is it's reversing this historical trend. Is that more and more people who are coming on chain are actually coming on chain to save. And from their perspective, they may not even be on chain. They're just on a fintech app, right? They're on some app that they downloaded that gives them access to dollars. They don't necessarily even know that they're using stablecoins. They just know they have dollars. And they might be in Southeast Asia. They might be in LATAM. They might be in Africa. They have dollars now. And now they have dollars. They want yield. Okay, great. They're going to get yield. And they're going to get that yield by using something on chain. But they don't know it's on chain. They just know you hit a button in the app and now I'm getting yield, right? Okay, great. And the app is probably using Aave, or they're using Morpho, or they're using something. Overwhelmingly, I think what will eventually happen is that this set of users who are increasingly building their portfolios and saving on chain, these people will start to buy, because the reality with stocks, most of the capital that's in the US equities market is passive capital. It's not people day trading. Most of the capital in the US stock market is passive. Most people are saving. Most people are investing long term. When we say investing in crypto, we often mean speculating. But when I say investing, I mean people buy stuff and they don't look at it for years, right? They don't touch it. It's sitting in a 401k or something and they literally can't touch it. So that type of behavior is starting to happen. It's only starting to happen now. But the savers on chain are mid to late adopters. So I think over the next 5 years, you will see more and more people who are starting to use on-chain as a way to passively allocate to stocks and to these assets. I think the speculators, the reason why tokenized stocks have not really worked on chain is that tokenized stocks are really only, they're fundamentally better for long-term holders, right? They're better for
it's a PMF thing. Yeah,
exactly. It's customer market fit or customer product fit is not really there yet. So those customers are coming on chain. I think that's going to make a lot of this stuff work. In the short term, that's why you're seeing more perps type products on stocks and equity indices are working much better than the tokenized alternatives. And I think that's why, is that the people who are here today, they're speculating. When vol in crypto is low and there's not much movement in the market, great. You can go trade AI stocks, you can go trade Tesla. Tesla's, for whatever reason, moving more than Bitcoin is. And if that's true, then great, that's what you're going to want to trade. And it's a lot easier to do that from, with all your USDC in your crypto wallet, as opposed to, taking that out, off-ramping it, bringing it into Robinhood, and then go trade it there. You can do it all in one place, which is all in DeFi. I think that's going to work for crypto natives, right? For the people who want to speculate. But for the savings activity, you got to wait for those savers to come on chain.
Just to layer on a couple things, Steven. I don't think it's a either or. I think both of these systems have tremendous value to the world, both the permissionless and the, if you want to call it, the semi-permission real-world asset stablecoin part of the world. I think it's just amazing both these systems are getting built in parallel. So the easy is yeah, of course, better, faster, cheaper finance for traditional finance means there's going to be lower fees. 30% of insurance premiums don't go to just claims and administration and just non-value add work. And more go into the pockets of normal individuals. It opens up access. We have an access and fee problem within traditional finance. There's a limitation to how far traditional fintech could take because it's still built on legacy banking rails. So fintech of the future built on, modern, what you're calling real-world asset and stablecoin rails is going to be empirically better. It's going to open up broader access to people. It's going to lower fees across the board, across payments, across asset management, across insurance, across every single vector of finance. It's going to be better. But let's not forget why these systems are being built in the first place. Bitcoin came out of the financial crisis. none of what I just articulated would solve the issue of like the US is 37 trillion of debt and it's 30% debt to GDP. And like, if we move to an authoritarian regime, which best believe, like we can't predict the way in which the world is going, especially when AI is such like a concentrating force. So whoever, if we're marching towards AGI and whoever gets their hands on that can consolidate power, it's like, we're going to really like the fact we have the permissionless world as well. And like, we've got the ability to store value and move it across the world if we ever got to get out of somewhere. So it's really valuable that both are being built. So I really don't think it's an either or. Like in the moment, yeah, of course, it seems like the institutional RWA side has a lot of value. But if, once again, we're having this conversation during COVID in 2021 when, 6 trillion was just printed. And I'm sure we'll be having the conversation again. The interest will be around the permission versions of the permissionless versions in Bitcoin again. So it's great. It's great that we have both systems. I think we've got to advance both. And I think at moments in time, one gets lost by the other, but I think they both benefit each other.
So a bit of a question here then with respect to DATs. If you're raising all this cash to buy this altcoin, which is providing this very, very large incremental bid, and it's been driving a lot of the narrative of this cycle, I mean, why would they not then put that into these DeFi ecosystems? Because it stimulates a lot of activity. Hopefully, it would generate way more interest in yield or interest from the on-chain metrics. Hopefully, you're generating a decent amount of yield that you can then pass back down and almost kind of continue this virtuous cycle. Why would that not? I mean, isn't that the whole goal of these vehicles? Like, why would that not be a main driver in your opinion? Especially when majority of people are not crypto native, they don't know how these things work, and they're kind of willing to pay a premium for exposure to these things, knowing that hopefully they get more yield in the end.
So a lot of these DATs are, or at least they're planning to put some of their assets into DeFi. The reality though today is that if you're a DAT, you are terrified of a hack. And of course, it's much more risky to be putting your assets into DeFi than it is to stake them. So most of these DATs today, what they're doing is they're just staking. And staking, for whatever reason, is seen as the quote unquote risk-free rate on any chain, in large part because there's a perception that if staking somehow gets broken or there's a hack, that there's going to be a rollback, a fix, like that the stakers are going to be made whole, and the chain is not going to allow stakers to get hurt. So the reality for most of these people is that they know is that if something in DeFi goes wrong, they're not necessarily going to get bailed out, right? There was no bailout for Ethereum balancer LPs for the balancer V2 ETH pool or whatever were the pools that got hit. So most of the DATs that I've seen so far, they've allocated a small amount of money on chain into DeFi, but the lion's share of what they have is in staking, and the rate delta between like low risk DeFi and staking yield is actually not that high. So you're getting most of the yield from just putting your money into staking because there's somebody out there who's willing to take the risk of the smart contract risk of putting it in DeFi anyway. And so that the interest rate differential is pretty low because of the fact that it gets arb by people who have a different risk appetite.
The one thing, and circles back on something that Haseeb mentioned earlier about stream finance, I worry, like every cycle in crypto, we repeat a lot of past mistakes. We forget very quickly. I'm not like, we've participated in a ton of DATs, like at least 5. I understand the value of them from the ease of, access, like having something with the traditional exchange wrapper, the ability to get the staking rate. There is some arb that could be realized when these things trade at a discount or premium, and like, why not monetize that? Like, advance the capital structure, appeal to convertible bond investors. Like, there's a reason why there's different forms of capital formation in traditional markets. Now, the one thing that worries me, and it relates back to stream finance, is like, I don't think a lot of the teams are fully equipped to do the asset management side, not just from, like the, what the underlying risks of the DeFi protocols. They fully understand the composability risk, the smart contract risk, but also just like the transparency side. It's like, I would love to see these DATs put their balance sheet on chain. I know the Avalanche DAT that Dragonfly we participated in, that helped sponsor and advise to, is a big believer in that. And I think the more and more, if we're putting assets on chain, let's make them fully transparent. Let's show the balance sheet in real time, the way that Sky ecosystem and Maker does. Otherwise, like, we're going to repeat the same things that happened in 2022 with Celsius, Voyager, You're just giving carte blanche to asset managers to go, take on a lot of risk. And it's a huge moral hazard problem. Like I'm already seeing it with some of these DATs that it's obvious to me the writing on the wall is they should sell M&A. They should either forget buying back shares, they just unwind the thing. They should unwind the thing or sell to a larger DAT. And they're not because the incentives are there.
Or convert it to an ETF.
A 1% to 2% fee, right? And you begin to get the moral hazard, and I worry you get like the whole negative externality that comes from that when they start taking on a lot of risk. So that worries me a little bit about the DAT side. I wish those were more thought through on the asset management side.
To me, it seems like it's going to be a natural. It's going to be a natural kind of another maturation point, or at least a signal or indicator for how Kelvin's original question is how institutional ready is DeFi? How do we onboard kind of institutions, or what's missing? What's the gap? And it seems like the more DApp participation there is, that's going to be sort of an indicator, a signal of where we are at in that cycle, this growing up cycle. Because I agree with you on a lot of things here, Sean, where a lot of the DApps that I've seen definitely are not set up the way, not set up with a proper kind of posture. But then others are. And then a lot of them are trying to grow into it, from what I'm saying. So it definitely seems like if you're a DeFi builder, here's a natural customer, especially if you're kind of bent towards an institutional side. Like, it's just waiting for opportunity. These people are waiting and are going to be increasingly competitive around figuring out how to find the best risk-adjusted yield. And Haseeb, I cut you off.
Yeah, the other thing I was just going to add is that one of the things that I think a lot of people in crypto have learned is how janky traditional finance and stocks are, and actually how inconsistent their reporting is, and how kind of lax the reporting requirements and latency is. So, if there was so much conversation about like, what is the MNAV of like these big ETH DATs? And actually, like, people didn't know. There was like not consistent reporting, and it was like delayed by multiple days. And it's like people don't know exactly how much ETH. Yeah, exactly. And it's like in crypto, this would never happen. It's kind of insane, but like in crypto, actually everybody knows the metrics of Aave at all times, moment to moment, block by block. And so this is one of these things where it's like, man, Edgar and like these, I have to like get a lawyer to fill out a form that I then file 2 days later after like doing a thing. It's like, why does it work that way? Can't this stuff be real time and instantaneous? It's just one of these things where like, man, these assets cannot get tokenized fast enough.
Do you think that's where, with these DATs, this is where it's going to go? Is that there's going to be a natural pull towards DATs just tokenizing the vehicle itself, just putting it all on chain and having completely transparent reporting? That's all, again, smart contract driven.
I think that'd be great. I mean,
I'm a little bit. I'm asking because I'm just a little bit unplugged. I mean, I was super involved a couple months ago, and then now I'm building stuff. And I know the Ford Industries, last I saw on this, Ford Industries with Kyle, they said that they were going to do that. Like, that was the express intent. They'll be
I believe they were tokenizing via Superstate.
Okay.
So I'm largely, what would I say? Like the tokenization for these companies is largely just about like instantaneous reporting, which doesn't seem like you need that much complicated infrastructure for. But the reality is the stock market is not designed for this. It's really not designed for instantaneous reporting, despite the fact that markets are instantaneous. In crypto, we're used to this because everything is on chain. You can literally go look up the instantaneous metrics for every protocol that you know and love. You want to know the hyperliquid volume right this second, go look it up. It's right there. You want to go see it for Aave. You want to go see it for Morpho. It's all there for you to consume at any given time. It's not reported quarterly, and it's not reported on, this form has to be filed within 7 days. This form has to be filed within 2 days. This only let us know if it's quote unquote material, right? For a DAT is such a simple object, right? It's like a pile of cash and tokens, right? Now, yes, like, look, you obviously don't want to be reporting trading activity in real time so the market can front run you. That makes sense. Like, I should not be able to see, you're on the Binance order books right this second. Okay, yeah, that makes sense. But the assets that are held relative to the NAV on the exchange, it's inconceivable to me that like it should make sense that it works that way, that we basically are kind of guessing how much ETH this thing holds and therefore what to price it in terms of MNAV.
Understood. And so, sorry guys, I know we're running a bit low on time, but the title of this episode is the Avalanche Thesis. So as two investors in Avalanche, why Avalanche and why now? Kind of curious how the story's evolved, how you got to this point, and why you're so bullish looking forward.
Yeah, so I've been a long-time investor in Avalanche. Actually invested in the seed round back in, what was that, 2019, I think it was, 2019. So the Avalanche story is the exact story that we've been talking about this whole show, which is about tokenization and the advent of institutions coming into the space. And the one thing that's very, very clear about institutions is that they have a very different kind of product that they need, and they have a very different risk appetite than retail investors. For the most part, like the big meta story that we've seen this year is institutions pouring into crypto, and all these institutions having to figure out their own strategy with respect to what they're going to do with respect to their blockchain crypto strategy. Crypto is now legal in the US, and every single company needs to have some response in terms of what they're going to do. And overwhelmingly, what you're increasingly seeing is all of these company-specific blockchains, right? You're seeing this with Tempo, you're seeing it with Arc, and more, I think you're going to see, so Avalanche recently had this partnership they announced with Toyota. They've got stuff going on with all these companies in Japan and Korea that are wanting to say, look, we need segregated block space. We saw what happened on 1010. We saw what happened when the president launches meme coin. We saw what happens when fees spike on all these different chains. It's like, well, look, we want to be connected to the broader crypto ecosystem, but we have our own needs, our own controls. We need certain restrictions on validators and or transferability or predictability. All of that stuff is why you see increasingly companies demanding their own customized block space. I think that trend is not going to stop. Now, that's not to say that I'm bearish on the standard big ecosystems like Ethereum and Solana and so on, but it does mean that the growth of all of the corporates and all of the tokenization that's coming on chain, it's a different model, and they require different kinds of block space. That's fundamentally the Avalanche thesis, and that's why I'm, as always have been, I'm very bullish on the ecosystem.
Yeah, mine's a little more circuitous than Haseeb's. Like, he was enough of a visionary to see the Avalanche vision initially and understand where the space was headed. I will say I was a healthy skeptic about the need for the amount of L1 block space. In fact, I was like, for the first couple years that I entered crypto from like 18 to 20, like a pretty big Ethereum maxi. But I just traffic in just really smart human capital. It's like what Haseeb and I do as early stage investors is understand like there's a limitation to what our knowledge base is, and just like where we see the best talent gravitate towards. And my story then touched with Steven's. Like, I met Steven. I've been doing work around just like LSTs in the Ethereum ecosystem, and my analyst was like, "You got to check out this thing coming in Avalanche. Like, there's actually a much more of a need for an Avalanche because these things are trying to bootstrap their own networks, and having like an eigenlayer, like a restaking mechanism where you share the security is like even more powerful." And that was the initial vision of Hypha, but a go pool. And then I just got introduced through Steven to the protagonists at Avalanche, from Luigi to John Nahas, to John Wu, and like up and down the stack. It was the first time I felt like there was a buttoned up approach to crypto that was just measured and pragmatic and playing the long game. And I just went, like the institutional use cases that they were purporting to me, I was like, this is exactly what I imagined when what we're calling the stablecoin real world asset thesis manifests on chain. This is what I envision it looking like. And clearly now, as we just chatted about, just like the enterprise blockchain thesis, proliferation of corporates coming on chain or needing a on-chain thesis that will need have very specific needs, right? It's the expression of the modular thesis that Ethereum has, but in a way to me that's much more digestible. When we think about institutions coming on chain, like they're probably even need to control down to the validator set, right? You can't just have like anyone validating a blockchain network. That's like a non-starter for many institutions. So it's just like crypto as the back end that sits quietly in the background. You get all the benefits of being on chain, but have all the control and modularity that you need in blockchains as fast as possible. So that was kind of my story, and I think the story is definitely still unfolding. Like, I'm really excited by the acceleration we're seeing in the Avalanche ecosystem. I use Arena every day as well. It's like forced me to use things in the ecosystem. I was a big proponent of Friend.Tech when it came out, and this is like Jason and team have delivered on like the initial Friend.Tech bit. It's way better. I love using Arena. I think the community is great. And yeah, that's like the Avalanche community is diehards. Like these people don't leave. You could say crypto is tribal in that way, but you need ardent supporters. You need people that fully believe in the vision, are going to stick around. And I just love meeting people at the Avalanche events that like have participated in the ICO, have been staking, have never sold Avalanche, and will never sell their Avalanche. Like this is their lottery ticket. They're going to stake for the rest of their lives. So yeah, that's kind of my lens into the red triangle ecosystem.
Interesting. And I guess I'll ask my last question. Maybe Steven, you have one more after, but you guys spoke about the importance, or I guess alluded to the importance of vertical integration. I was kind of curious, what was the first like symphony like you saw on chain? You're like, oh wow, this would not have been possible if it wasn't vertically integrated.
This would not have been possible if it was not vertically integrated.
Either that, or there just would have been a ton of friction, a lot of pain points, maybe issues the user experienced, just something that was even novel for that matter. I haven't seen this in a blockchain before.
Let them cook, Kelvin. There I can see their gears are turning.
I mean, actually, I think Friend.Tech might have been the first example I can think of that this like when you say vertically integrated, I imagine what you mean is like they sort of own every piece of the stack and they're kind of running the whole thing end to end. Friend.Tech, I mean the OG Friend.Tech, not the revival. The revival, obviously, and then things they did the token and it kind of fell off a cliff. But the OG Friend.Tech was kind of one of these real magic moments in crypto, where creating this like social experience where like you had these paid rooms that people everybody was coming and buying each other's keys, and it was like this incredible just like, oh, this is one of the things that crypto can do. It's just such a total different modality of social that's only really enabled by integrating these financial primitives, integrating chat, using your social graph. It was kind of just this. It was very much like a symphony moment.
Yeah,
where it's like I've never seen these instruments put together making this kind of music before, and it sounded really good. Obviously, Friend.Tech, had a very, very ignoble arc after that. But that was very much like one of these real light bulb moments for me.
And I can go next, and then Sean, you can close us out. But for me, it was Helium, where I'm always obsessed with it because my very first startup was in a very archaic, very, very large TAM industry, but very boomer, right? It's like moving to spreadsheets was the big revolution for them. That was happening in like 2012. And then telecoms to me always seemed the same way. And I'm always like so interested, like the very fact, like Google Chrome is another one. Like, do you know how hard it is to change something about Chrome? And yet every single device in the world, 90% of the devices in the world uses Chromium. Like that's like just insane to me how large and ossified some of these industries can be. And then as an innovator or as someone trying to create wealth for the world, so trying to solve problems, produce value, those industries to me have always been just the most tantalizing thing, but also how do you compete? Like what is the actual business model that you can have that differentiates against the skills economies that are already created? And to me, telecoms are the same. So with Helium, what I saw there, I was like, oh shit, like this is the crypto promise. Like, this is why I got into crypto. It's like, here's an alternative model to compete against traditional businesses, where now you have this imaginary thing of a token, you can create your distributed incentive sets, and then they were actually able to produce like a fairly good a network for a fraction of the cost that would have costed Verizon or someone else to bootstrap themselves, where there's all sorts of government subsidies, and it seems like all of them could only happen in like a brief period of time between 1980, 1995, because that's when the focus was on this, and this was the kind of the hot thing as the internet was starting to become a thing. So to me, that was the main aha moment for me. I was like, oh shit. And then that's how Avalanche fits in for me as well. It's like, oh shit, now here's a powerful new tool that any innovator can pick up and compete against any industry in the world with something that's sharply different. That literally Verizon cannot compete against Helium in a traditional sense.
Yeah, as the DeFi enthusiast, where I spend half my time, 75% of the time is DeFi and 25% like the intersection of crypto and AI. I distinctly remember the first time I hit trade on Uniswap. And as someone who comes from TradFi, to know all the plumbing that goes on behind the scenes and clearing and settlement, And just within 12 seconds to move from token X to token Y, it was like an incredible experience where it was actually custodially in my wallet as someone had participated through ICOs and you had used Binance before it was shut down here in the US, and now obviously full circle will be opened back up at some point soon with CZ's part in. And then what's not even appreciated about a lot of things in DeFi is like these things where the curtains are kind of drawn down, or you don't have full visibility, or like don't know how they work. It's like to market make and become a liquidity provider on Uniswap through like a simple mathematical formula. Obviously, it's expanded with V3 and V4, and it's much more modular, and you can put any invariant curve, but like a simple mathematical formula where like I could earn fees by holding 2 tokens and like not someone else, and just like holding a automatically rebalanced portfolio. It just, people don't fully understand like how much that has collapsed the costs of trading, and then just opened up the aperture for normal people to participate in what is like an institutional finance function of market making. So I'll never forget that feeling, and it's like what's galvanized me. And similarly, like I had a similar experience in sort of this convergence of crypto and AI, where like having a sentiment model running, like tracking my Telegram and Twitter and people who I think have alpha. And like the first time I saw like AI, buy something in my wallet for me without me doing anything was like another moment for me of like a sneak peek into the future of like, this is, there's been things written about like self-driving banks, like, like self-driving money, like that just like autonomous in your wallet is gonna move in and out of the best risk-adjusted return for you and tokens for you. I think we're seeing a sneak peek of the future with this convergence of crypto and AI.
All right, cool. Yeah, I guess I could share since last, but
got it.
I'd say Uniswap.
Yeah, you have to.
I feel weird if I didn't. Uniswap was a beautiful one. You already said that, but honestly, I'm gonna have to go with Pump.Fun. It was a really weird experience to be like, wow, previous cycles, people spent all this money hiring devs, writing Solidity, reading the bytecode, all this stuff, like looking at all this weird, super technical stuff. Like, oh, now you just click a button and you create a token, and the website's super schizo. You see all these things shaking. There's all these weird UI elements that it almost tapped into something like as native to crypto is just the volatility industry of itself. Like that attention economy. I was like, oh, this is insane. And I mean, you have my friends who are not even in crypto referencing Pump.Fun and all these different launch pads and whatnot. I mean, the fact that I dabbled in like crypto, social media, SocialFi related stuff before, but the fact that they exploded as quickly as they did was just mind boggling. I couldn't even wrap my head around it. I mean, I'm walking down the streets of Japan and this guy has Pump.Fun open on his phone. I don't know who he is. I'm just in another part of the world chilling, just trying to enjoy my day. And crypto kind of pops up. When I see those kinds of things, I think it's truly beautiful, even though whether it has led to an altcoin heat death kind of thing is a whole nother conversation. It was a pretty magical moment watching that take off. Hopefully I don't get roasted in the comments for that, being a Pump.Fun sympathizer. But that's why I got the little Cupsy plushie right here, Elon somewhere up there. But yeah, guys, we're a bit over time, but really want to say thank you so much for taking time out of your days to chat. This was the inaugural Layer 1 podcast. I think it was a banger. And yeah, thanks for joining.
Thanks for having us.
Thank you, guys.
Thanks for having us. Yep.